Apple shares are down more than 3% today after the market opens for the first time in 2024. We're going to understand why exactly this powerhouse of a company is down. We're going to run through their historical performance. We're going to take a look at their revenues, whether they've been increasing over the last few years, as well as their bottom line net income. We'll have a quick snapshot at the health of the company, their total cash versus their total debt. We'll also quickly compare how they performed in 2023 as well as the last 5 years versus some well-known competitors. We'll analyse their dividend safety, looking at their financial metrics, as well as seeing what the institutions have been doing over the last few quarters. And then we will jump into our valuation model, getting to our intrinsic value and finding the acceptable buy price of Apple given our investor margin of safety. Now, jumping straight into the article from CNBC today, we see that Apple shares fell more than 3% after Barclays essentially downgraded the stock and also trimmed their price target, and we'll touch upon that very shortly. Now, the reason for this is they say the weakening iPhone 15 sales, which were released last year, as well as a warning sign for iPhone 16, as well as a broader hardware projections. Now, we can take a look, and this is something that we can see has been worrying investors and analysts alike since October. So what we can see when we do run through the article is a bit of a joke, really. They trimmed their price from $161 to $160, so it is essentially a $1 reduction, but they have downgraded the stock. So what they essentially say, lackluster sales from the iPhone 15, and they expect the same for iPhone 16, and this is something that they believe will hold true for Apple hardware sales as well. Now, they are saying they're picking up weakness on iPhone volumes and mix, as well as a lack of bounce back in their Macs, iPads, and wearables. So let's take a look at the analysis. Now, today they are down over 3%, as we can see, over the last 5 days, in fact, around 4%. They are still trading towards the mid to upper end of the 52-week range, and they offer a yield of around 0.5%. Now, for those long-term investors, if you've been holding this, well, this would have been a great company in the portfolio, up around 881%, and that is if you haven't been including those dividends reinvested. So in terms of their revenues now, what's typical, we like to see 3 to 7% growth year on year as a minimum to the top line. September 2019, 260 billion reported. September 2023, 383 billion. So an incredible jump over the last 5 years. But one thing to note, when we do look at a year-by-year basis, we see an increase all the way to 2022, although note to 2023, it did drop down to 383 billion. So this is one of the reasons that investors are looking at a cause for concern, the demand for the iPhone 15 as well as the potential 16, and they don't see that the iPhone can continue to pull Apple along in terms of their top line. So if we jump into their bottom line net income to see what story we can see here, well, 55 billion reported in 2019, 97 billion in 2023. So again, we see a nice jump over the last 5 years. But when you do take a look year by year, we do see an increase to 2022, similar to the top line, before a drop into 2023. So overall, the financial statements, and particularly the income statement, it is looking positive. They are increasing their top line and their bottom line, but we do note from 22 to 23, their last annual report, their top line as well as their bottom line has dropped. Now, a quick health check, total cash versus total debt, 101 billion of cash and short-term investments on the balance sheet in 2019, 61.6 billion in their latest quarterly report. So their cash position has dropped tremendously, in fact, nearly half what it was 5 years ago. And when we compare that numerically and directionally to their total debt position, we see the opposite effect, 108 billion in September 2019 to around 124 billion. So it is important to note, whilst their cash has nearly halved over the last 5 years, their total debt has increased by around 20%. Something just to keep an eye on. Not that it is a massive issue right now for Apple, but we can look at some of the net debt to EBITDA metrics just to analyze how that looks for the company. Now, comparing their performance over the last few years, we have other companies in the technology, hardware, software company, Dell, HP, Hewlett-Packard, as well as a few others. Now, 2013, we saw Apple up 45%, including those dividends reinvested. In fact, surprisingly, they were one of the middle in their competitors and their peers. We see other companies, Dell up 89% last year, and STX up 68%. Now, if we extend that to the last 5 years, what we see, in fact, Apple the best performing by quite some way, nearly up 400% over the last 5 years. So something to bear in mind, but as I always say on every single one of these episodes, past performance is never an indicator for the future. Now, taking a look, 58.51% institutional ownership, around 69 billion worth of outflows by the institutions. However, during the same period, we see 176 inflows. So institutions are buying more shares than they are selling. One thing to note, 2023 Q3, we actually see more selling than buying, and Q4, we see relatively no movement. And if we look at the other 2 quarters in Q1 and Q2, slightly more buying. So overall, yes, institutions are buying more shares than they are selling, but in the latest quarter, or Q3, in fact, we see a little bit more selling than buying. But as always, this shouldn't really drive your decision as an investment, whether to buy or sell. It is just one level of review that we do here on the channel. Now, Dividend Safety score 99, it is very safe. Market cap just shy of 3 trillion, so a mega cap company. Recessionary metrics for those that see a recession inbound in 2024, while they didn't pay a dividend, so no metric comparative data there. Recession sales plus 14%, well above the average growth, which was in fact negative 12%. And we can see recession return, they're negative 50%, while the S&P came in at negative 55%. Now, dividend growth, in my opinion, fairly poor for a company like Apple. I would expect some significant growth, especially considering that very small yield of 0.5%. 4.3% last year. Now, that is pretty much in line with the 4% that I advocate on the channel to get in line with inflation. And then we can see here the last 5 years, 7%, last 10 years, 9%. So it isn't bad, 9%, but I would expect to see double digits from a company like Apple. Now, when we take a look at the dividend growth, 11 years of increasing those dividends. Now, dividend yield theory, for those that are new, states the company is undervalued when the current yield sits above the 5-year average. So we have an argument here for overvaluation with that current yield sitting below the 5-year average. But remember, we never look at any of these models in isolation, and we will draw conclusions towards the end. Forward PE, a very similar story, higher than the 5-year average, 28.3 versus 25.8, so another sign of potential overvaluation. And we see it sitting higher than the sector PE, information technology, of 24.8. Now, always look at the free cash flow payout. The earnings is susceptible to manipulation by management through accounting. And personally, I like to see below 60%. It gives me faith that management can offer those double-digit dividends. And this is one of the reasons why I am disappointed in Apple. We see a very low free cash flow payout. In fact, the last few years have been below 15 or around 15%, yet the increases are very mediocre in my opinion. You're getting a 0.5% yield last year, and it only kept up in line with inflation. Something to think about, but I do understand a lot of people, in fact the majority of Apple investors, aren't looking at that dividend yield. They are focusing more on that share price appreciation, but there are just some things to consider depending on your type of investment and what you are looking for as an investor. Free cash flow per share, well, $2.05 in 2014, $6.33 in 2023. We do see it has increased by more than 3 times over the last 10 years. But do note, 2022 to 2023, it did drop. So something just to consider if you are thinking this isn't a company that will continue to increase the way it has over the last 5 to 10 years. Sales growth, as we mentioned, 3 to 7% for steady moderate growth. And what we can see here is over the last few years, pretty inconsistent. We see some years of single digit growth, double digit growth, negative digit growth, and so on. So it will be interesting to see the next few years. But do note in 2023, as we discussed earlier, negative 3% growth to their top line. Total sales then numerically 183 billion in 2014. They've managed to more than double that in 2023 to 383. Now, one thing they do very nicely is returning excess cash to investor pockets by doing share buybacks. A very strong share buyback rate over the last 10 years. 24.5 billion in 2014, 15.8 in 2023. ROIC, as always, I tend to invest in companies that have 10% or more. Gives me faith that they are able to effectively allocate their capital. And we can see management, a very strong rate here. 65% in 2022, 61% in 2023. Apple has an incredibly wide moat. Both margins looking very healthy and strong, well above the minimums on both accounts. This is a very strong free cash flow machine, as we can see, in the mid-20s consistently. Finally, net debt to EBITDA, earnings before interest, tax, depreciation, and amortization, shows us two things: balance sheet strength, dividend safety, and we can see here why that dividend safety score sits at 99. These are the numbers, in fact, that it shows how many years it would take the company to pay off all of their debt net of cash on hand. Apple coming at 0.44 in 2023, so we can see they also have a very strong balance sheet. Now we can jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And let's jump straight in. Now, typically, Graham's valuation would be the first model that we use. However, these are models that we don't use for REITs or for companies that do have quite high growth rates. It is fairly subjective. Some people would include it, some wouldn't. For today's episode, we will exclude it and jump into the first model. And we have the multiples valuation model, companies in a similar sector and size. We have Microsoft, Meta, Adobe. We have their P/E multiple, the average, which we multiply by Apple's earnings per share, to give an intrinsic value at $236. Now we can see the market value at around 186 currently, which means it shows a sign of undervaluation based on this model. But as always, we don't draw conclusions on any models and draw them towards the end of the episode. The dividend discount model, so we have the yearly dividends with the growth rate, average growth rate of 5.64%. Now, the reason why I've gone higher, which isn't typical of me on the episodes, is that I do believe they will start to increase that dividend. It was a very small increase, in my opinion, over the last few years, keeping up in line with inflation. So I have gone for 7.25. As always, though, if you do believe it's too low or even too high, you can grab a copy of the model below and run your own numbers through to get your own figures. This gives an intrinsic value of $137, as we see here. The market value higher, therefore we have a sign of overvaluation. We then jump into the DCF model, where we have the free cash flow year on year. Average growth rate at 12.2%, analysts expecting slightly lower at 10%. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get the intrinsic value of $227. Again, showing room for growth and showing us an undervaluation signal. So the intrinsic value for Apple in this episode is just the average of these three models. And as we can see, that comes to around $200 pretty much on the dot. Now, the current price sitting around $187. We start off with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. We can see it isn't really a buy up until $180. So when we use 5%, we can see it is a buy. So right now, you are getting between 5 to 10% margin of safety for Apple based on our estimates and judgments. Now, what do Wall Street say? Well, they believe the upside to be pretty much near that intrinsic value at around 10%. So in conclusion, for Apple stock, right now we do see around a margin of safety of 5 to 10%, with Wall Street forecasting around 10% upside over the next 12 months. Now, personally, what I do believe, this is one, whilst I would like it to add to my portfolio, it is extremely high in terms of the valuation. It isn't one I would be looking to add. And right now, what we are seeing in the market is a lot of essentially money being poured out of these tech stocks. If you have a look at the other tech stocks, they are also bleeding. A few percentages is nothing crazy, but they are essentially having money rolled out of these tech stocks, which had a very strong 2023, and moving into different companies with high yields. If you look at AT&T, up over 2%. You have the healthcare stocks also up around 2-3%, even Altria Group. So I think for 2024, right now, it could be one where money is pulled out, rotated out of tech stocks, so you may be able to lock in some of these tech stocks at a lower price. That is just my 2 cents. But as always, do let me know your thoughts in the comments below. If you've enjoyed this episode, smash that like button, hit the subscribe and bell button to be continually notified of these videos as they drop. And finally, do click on that pinned comment below where you can get to the intrinsic value and acceptable buy price of companies in your own portfolio. As always, have a great day and catch you on the next episode.